Monday, August 11th, 2025, Maneco 64, home of alternative economics and contrarian views. Well, today we're going to look at whether the average American saver who's putting money aside every month for his or her retirement is going to be used as a bag holder for alternative assets. Yes, this is a dangerous situation in my opinion, yeah, President Trump just passed an executive order to allow average investors to do so. Before we look into this though, just wanted to thank all of you for your interest in the channel, and a lot of you, from looking at the statistics, watch the channel but are not subscribed. So if you really enjoy my content and haven't subscribed yet, make sure you do. And yeah, thanks again. The other thing I wanted to touch upon quite briefly is the U.S. economy. We saw that the last jobs number, the non-farm payroll, came out quite weak at 70,000 or so. Yes, the expectation wasn't great. It was 110,000. It sounds a lot, but the U.S. economy actually needs over 200,000 every month to keep up with the population growth. Also, the previous 2 months were revised down quite sharply, a total of 258,000 jobs. And you can say whatever you want about the BLS and statisticians. Yeah, these numbers are just estimates, actually. The non-farm payroll, they're like surveys done and then they extrapolate. But be as it may, I think the economy could be weakening. We've seen treasury yields, especially in the 2-year, come off a little bit. We've seen even the longer end come off, and we're seeing some anecdotal or some data out there that are pointing to weakness. For example, Professor Stephen Hanke just noted in a post yesterday, he said, another leading indicator flashing that a U.S. slowdown is baked in the cake. Americans ate 1 billion fewer meals at restaurants between January and March compared to the same quarter last year. So the other thing I've been looking at, for example, is the Michigan Consumer Sentiment, which is a statistic, that's followed quite very closely by the bond markets, by equity markets. And I know this because when I worked in the markets, it was always a number we looked at. And the consumer is very important, of course, for the U.S. economy. It's, I think, more than 2/3 of the economy is dependent on consumption. Unfortunately, it's not a very balanced economy, just like the economy here in the UK, also based a lot on consumption, credit. But anyway, as you can see here, the latest number for the Michigan Consumer Sentiment was 61.7. And if you look at the long-term chart going back to the 50s, it's near the bottom of the range, really. If you look at 08 and 2011 there, when we had the Great Recession, that was around the mid-50s. Same thing in the early 80s when you had that double dip recession. It dropped quite sharply. Yes, in 2022, it dropped there below the 1980 level. That was when they shut the economy on purpose for you know what, which was, of course, a total exaggeration. Just look at Sweden. They didn't shut anything down. But that's a different topic. But as you can see, we're not like where it should normally be, like when the economy is doing well. which means at least 80 to 100. So there are signs there that the economy is slowing down, and I think the chairman of the Federal Reserve, Jay Powell, he's probably worried now because he's held off cutting rates, and you can understand maybe why he didn't cut rates, because everything in terms of financial indicators is doing really well, all-time highs, right? In the NASDAQ, S&P, and the Dow. Financial conditions are good. And that, of course, is because, we've got a melt up because the Treasury has been involved as well in doing a lot of monetary policy via the back door, and that's provided a lot of liquidity. Not just Janet Yellen issuing more short-term paper, but also the new Secretary of the Treasury, and they're going to do what Yellen did, and I think that's why the Fed has held off. The other thing is when they cut rates last year in September and thereafter, like a total of 1%, we didn't see longer term yields drop. They've actually gone up. The 10-year went from 3.6, and right now as I speak here, the 10-year is at almost 4.30. It's at 4.27. And that, in my opinion, is because foreigners are buying a lot less treasuries. That's the problem as well. The U.S. has so much debt that it needs the kindness of foreigners to lend to it. But with all that's going on vis-a-vis tariffs, there's a lot of animosity, a lot of soul-searching by other countries saying, do we really need to keep buying these treasuries? Do we really need to keep dealing with the U.S.? And I think that's going to continue. So, yeah, that's why Powell, I think, has held off. But now he's worried because it looks like the economy could go into recession very quickly, and it happens quickly. And unfortunately for him, the next FOMC meeting is in like 5 weeks, September 16th to the 17th. So if we were to see continued weak data, and especially the next jobs number at the beginning of September, I wouldn't discount the fact that they could do an intra-meeting cut, and that would be that would be a mistake in my opinion, because it would show that they're panicking, but they might have to panic. So keep that in mind. I think we are in interesting times, not just geopolitically and trade-wise, but also economically. It could be the trigger actually for a big correction in the stock market. Maybe not initially. Maybe initially the market would rally, but then people would go, wait a minute, why have they cut rates before the meeting, or why have they done an intra-meeting? So just wanted to put that out there. It's been done before, intra-meeting cuts. Of course, they never do intra-meeting rate hikes because central banks are there to inflate everything so that Wall Street can keep its liquidity game going. And talking about Wall Street, let's get to this executive order that President Trump signed. It says it's an executive order to, democratizing access to alternative assets. For savers, I guess. It doesn't say anymore here. And I got this from one of the viewers. And one thing I would say before we look into this is that personally, I don't think governments, regulators, or fund managers should have any power to dictate to an individual who's free and independent what to do with his or her money. So I'll put that right out there. I don't like these regulations. I think government shouldn't be involved. And I think the individual should do his or hers homework and due diligence before investing their hard-earned savings. So why am I talking about this? Is if I believe it should be basically a free-for-all because you learn the hard way. Well, because it's the way it is right now. And I think a lot of people could be hurt, small investors, people who aren't like high net worth individuals, or in the US, they have another classification. They're qualified investors, or you have to have over a certain amount of millions in liquid assets, and you can invest in these things like private equity, alternative assets that are not traded in a public exchange. They're not as liquid. And I think, unfortunately, what they're trying to do here is pass the bag to the small investors, because private equity is in trouble. I spoke about this a few months ago. I have a couple of friends from a wealthy family, and they wanted to get out of their private equity earlier this year, and they did, but they only got, I think, 70% at the most, around 70% of the price that was being listed as the worth of the asset. And once they went through with the sale, they had to wait months to get the money. So what's happening here? Well, private equity, they use leverage, and they've really come on strong, I'd say, in the last 10, 15 years. And why is that? Well, because after the '08 crisis, the central banks, they were giving away credit for nothing. So private equity, that's what they do. They borrow heavily, they leverage, they buy depressed assets or companies. They do a restructuring, which usually means getting rid of a lot of employees, and then they flip it and try to make a profit. That's what they do. But now, ever since, let's say, 2020, and especially 2022, the bull market in credit, or the bull market in bonds, or the bear market in yields, which is a good thing, is reversed completely. And I think they're sitting on a lot of stuff out there that they can't get rid of. And I think the average American who has funds in their retirement accounts, 401ks, or whatever else you have, they might not be aware of this, because they leave it to the managers. If they have money with a company, pension fund, or a state or public entity, they trust these managers. They think they know what they're doing, and I'm afraid people could get hurt. So let's just go through this executive order here. It was passed or signed into law, I guess, August 7th. Not into law, but it's an order, of course. It says, by the authority vested in me as president, by the Constitution and the laws of the United States of America, it is hereby ordered, purpose. Many wealthy Americans and government workers who participate in public pension plans can invest or are the beneficiaries of investment in a number of alternative assets. Yet, while more than 90 million Americans participate in employer-sponsored defined contribution plans, the vast majority of these investors do not have the opportunity to participate either directly or through their retirement plans. in the potential growth and diversification opportunities associated with alternative asset investments. And there's a list here of these in section 3. It says democratizing access to alternative assets. One is private market investments, including direct and indirect interest in equity, debt, or other financial instruments that are not traded on public exchanges, including those where the managers of such investments, if applicable, seek to take an active role in the management of such companies. Why is this important? Well, because right now these 90 million Americans, their retirement funds are in the public markets, and public markets are normally, most of the time, very liquid. You can just sell your stocks and no problem. But in private market investments, that's not the case. It could take months, just like the example of my friends, or it could never happen, right? So there's the first risk. Number 2, direct and indirect interest in real estate, including debt instruments secured by direct or indirect interest in real estate. Well, why does it have to be that people invest in a pension fund or contribute to it and they invest in real estate? Why can't an individual just do it on his or her own? Well, I think it's unfortunately the whole pension fund industry is a Wall Street construct to keep your money with them so they can make their fees. But be as it may, that's another dangerous aspect. I think here in the UK there was a fund some years ago, the Woodford Fund. They invested in real estate, and when investors wanted to cash out, they couldn't, because it takes time to sell real estate. And I wonder if they're going to put a lot of the 90 million Americans' funds into commercial real estate, because we know commercial real estate is in trouble. And a lot of the small to mid-sized banks have a lot of assets in that sector. Another red flag. Number 3, holdings in actively managed investment vehicles that are investing in digital assets. Yeah, I'm not against people punting in digital assets, but I'm not too sure about putting your retirement funds in there. Maybe if you're young, that's fine. But if you are in your 50s and 60s, I'd think twice about it because of the volatility. Number 4, direct investments in commodities. Well, yeah, the person who sent me that said, well, that should be really bullish for gold and silver. Not necessarily, because you can already invest in gold and silver through your 401k. You can already invest in mining companies. So I'm not too sure about this one. This would be probably in private projects. And again, private projects are interesting, but unless you're really sophisticated and you know what you're doing, I would stay out of this. Number 5, direct and indirect interest in project financing, infrastructure development. Number 6, lifetime income investment strategies, including longevity risk-sharing pools. I'm not sure about that. And yeah, so I'm going to stop right here. And it's interesting because there's an article that just came out yesterday in the FT. Am I apologist for the FT? Do I like the FT? No, I subscribe to it because I need to know what's going on. If anything, I think the FT is a shill for the elites and Wall Street and the City of London. I've spoken about this editorial that they did in 2004 where they said that gold was pointless and it was finished, going gold. So yeah, but sometimes you read things and you kind of agree with it. It says Donald Trump exposes U.S. retirees to new world of risk with 401k order. Move to refashion financial future of millions of Americans followed intense lobbying by private capital and crypto groups. So there you go. Dangerous. Again, as I said, people should be free to do what they want. I'm just giving you a warning here. So it says here as well, and this is a bit worrying, it follows heavy lobbying by private capital groups such as Apollo Global Management and Blackrock, who see access to those retirement plans as a path to drawing in hundreds of billions of dollars in lucrative assets. It says the measure is expected to open retirement funds to a new array of unlisted investments, from corporate takeovers and private loans to infrastructure deals. In doing so, it potentially exposes them to higher fees and less transparency. Some of the $9 trillion held in these 401k plans is likely to be shepherded into assets that are harder to value and sell than the traditional stocks and bonds that today comprise the vast majority of retirement plans. Yeah, and you can bet that these groups, it says here, Wall Street was able to win Trump over on an order that should give the industry important political and legal cover as it looks to convince managers of 401ks to add their funds as part of investment programs. Their campaign included heavy lobbying effort by Apollo, Carlyle Group, and Blackrock. So I wouldn't trust these people as far as I could throw them. Yeah. And I think this is what it's all about. It's not just about raking in more fees, but also paying off like the accredited investors, the wealthy investors that are trying to get out of private assets or alternative assets that are highly illiquid. So yeah, unfortunately, I think a lot of people could be left holding the bag. And if I were an American who had one of these retirement accounts or defined benefit accounts, I would look into it very carefully with the company I work for, or also the managers if you can. And yeah, I would be concerned. And as I said, I think people should be free to do whatever they want. So this is just a warning. And it's also maybe a double-edged sword, right? It could be an opportunity. So anyway, it's 7:45 a.m. London time. So let's quickly look at the markets. We're seeing gold and silver come off a bit overnight. Could it be related to what happened on Friday, the tariff on gold bars? A little bit, but I think it affected more the futures, and most of you know that I follow more the spot price. But be as it may, spot gold right now is at 33.65, right near the lows of the overnight session, is down 1%. Silver is down about 0.8 at 38.06. I'm not concerned. I'm going to keep stacking. I'm going to keep holding on to my miners as well. What about the stock market? Well, the Dow futures is up 116 points. S&P is up 13. The NASDAQ is up 40 points. The currency market is very steady, not much happening there, and nor the bond market. So with that, I'm going to wish you all a very good day and a very good start to the week. Take care. Bye.